Alright, welcome back to MMG. So this video is going to be interesting and important, and it's a little difficult to explain, but I have visuals, right? And I have charts and all kinds of things I can show you. First of all, not financial advice. Consult your financial advisor before doing anything. I'm not a licensed financial advisor. This is more of an educational channel. Listening to me rant could be completely wrong. Stocks, equities, currencies, everything's extremely volatile, extremely risky. Don't know what to tell you. All right. So if you a lot of you know what the dollar milkshake theory is, right? And let me play a little bit of it, just a little bit. I can't play a lot, and I'll give him credit and everything. So let's listen to him. This is Brent Johnson. I will link this video in the newsroom, and you guys can watch it. All right, let's just listen to a little bit of it.
Focus on the majors, which is the euro, the yen, and the dollar. Not much is really going on. But if you step back and you take a bigger view of the dollar versus a number of world currencies, the dollar is clearly wreaking havoc. You've seen this in places like Argentina. I mean, their currency is now down 60% versus the dollar in the last couple of years. Their stock markets are in the same range. Same thing has happened to Turkey. Same thing has happened in Venezuela. I've talked before about the Highlander example between, the dollar and gold, or kind of like Connor McLeod and the Kurgan from the Highlander movies. And at the end, there can be only one. And, I think gold will ultimately win that battle. But I think that battle's a few years down the road. I think in the meantime, the dollar's going to go around the world cutting off these other currencies' heads. And I think that's what we're starting to see. And I think you're going to see more of it going forward.
What's your view?
All right. So he's right. He's absolutely right. And here's the exciting thing about this, right? If the dollar strengthens, this is exciting for U.S. citizens, because your labor, right? You get your paycheck, whatever you do, you make dollars. And if the dollar is the cleanest shirt in the hamper, the economy is the strongest in the world, and we go into a global financial crisis, right? And the dollar strengthens, and like you said, cuts off all the other currencies' heads. And I'm going to explain why he says that, by the way. In the U.S., we will experience, even with a economic slowdown, we will experience a depression, sort of, or a deflationary depression, right? Now, that means if you have a job, that means things are going to get cheaper. Now, I disagree with that. I do agree with him when he says that the dollar will appreciate against other fiat currencies. But that does not mean it's going to appreciate in the real world. Meaning that does not mean that the dollar is going to strengthen versus energy, versus services, products, like insurances for all kinds of things. It doesn't mean the dollar is going to strengthen against your utility bills, rent. Doesn't mean it will strengthen against food. But that doesn't mean that it won't strengthen against the rest of the fiat currencies around the world. Now, he thinks that because his theory is the rest of the world has taken out debt, right? In dollar terms. And a lot of countries have their external debt, most of their external debt denominated in dollars. So that means they have to pay back that debt with interest. And all dollars created into existence, right, by the Fed, the ones and the zeros, and then the small percentage of paper, that's a certificate note of debt. It's not money. Okay, that's the first problem that people don't understand. Every dollar bill, it's a note. It's a certificate of IOU. It is an IOU, right? It's debt. All right. So all these foreign countries, I mean, some less than others, but most of the top 10 to 12, G12, whatever, G7 countries, G20, they all took out debt in dollars. So that means they have to pay back the debt in dollars. If the dollar strengthens, they're in deep trouble, right? And we see that happening right now. So this milkshake theory is actually happening right now. That's why the global slowdown's happening, is because the dollar strengthened. Why did the dollar strengthen? Well, that's because the Fed started raising interest rates again. Okay? And here's a chart. So the candlesticks, right? That's, what is that? That's the US dollar. And the Fed started raising interest rates. Let me remove gold here. So the Fed started raising interest rates. The first time they did it was in the end of 2015, December 2015. Now, prior to that, the dollar rallied in a really big way because the Fed started talking about that it's called forward guidance. They start warning the market, hey, we are going to we're going to raise rates, interest rates, the treasury bond rates, right? So the market looks forward, and then they start pricing things in ahead of time, because markets are always forward looking, because everyone wants to get ahead of everyone else on a trade, right? So then the dollar rallied. Okay? Just to give you guys a visual. Now let's get back to this. So, because and not just that, central banks around the world, Europe, negative rates, China, they've been cutting rates, Japan's been cutting rates for decades now, and the rest of the world, I mean, they're in the same boat. They're printing money. But here's the deal. If these countries' loans start defaulting because the dollar's too strong, then what happens is the money evaporates. So when there's defaults on bonds, when there's defaults on any bonds, like corporate bonds, sovereign bonds, government bonds, anything, when there's defaults for any loans, what happens? Well, the money disappears, because someone's debt is someone else's wealth. When someone defaults on the debt, then they can't pay back that money, and then someone else's wealth just disappears. And, you know, that's just how it is, right? Don't lend out money if you don't think that person can pay you back. All right. And the milkshake theory says that if there's a bunch of defaults, then the value of the dollar will go up, because then the supply drops, because technically there's all that endless loans made, right, in the debt. So if you understand fractional reserve lending, all right, the Fed prints a dollar, right? Then the banks buy that dollar, and then they get a small interest on it, depending on what the interest rate is, according to whatever the Fed sets it at. In Europe, they're like negative. So technically the banks, they lose money when they take the treasuries, right? But then they get all that cheap money, and then they can lend it out at a multiples of what it is. So the bank takes $1, and then they can lend out $99. And then where does $99 come from? They make it up out of thin air, literally. This is called fractional reserve lending. And then those dollars go into the economy, and then that could actually repeat as circulation of fiat goes into the economy. So $1 as it goes through the economy has even more multiple effects of it, because then those people take that dollar, let's say someone else takes that dollar and then deposits it in another bank. Well, when there's deposits being put in a bank, right, the bank can lend out like 90% to the amount they have on deposit. By the way, when you deposit money into a bank, they don't take your money and they don't take your money and lend it out. They just have on their balance sheet your account and the money you have in it. Let's say there's $10 million that the plebs deposited into a bank. That bank can now lend out $90 million. But they make that out of thin air. They just enter onto the ledger liabilities and assets, right? And then they'll just enter on the ledger that they're lending out 90 million, and then they lend it out. And that's how credit just keeps expanding and expanding and expanding. But the debt has to be paid back. So in order for the bank to collect the money and to actually ever have it for themselves, the people who borrowed have to pay it back. Now think about this. If a certain amount of money is made into an existence from the central bank, and then the banks lend out multiples of it, how is that ever going to get paid back with interest? Because there's interest on all of this. If the central bank doesn't create more and more and more and more and more money. It's like a hockey puck stick, right? As the central bank makes a certain amount of money, they have to make more and more and more so everyone can pay off their debts. But that's unsustainable, and it's hyperinflationary. But through their models and whatever, they say that they could raise interest rates and then ring in on all the debt. And Paul Volcker did do that back in the day, right? Where's that chart again? See this huge spike in the dollar, the value of the dollar? That's when Paul Volcker raised interest rates like 20%. And then the money supply shrunk. But what happens when you do that? Well, defaults are going to happen because people can't pay off the debt. And the economy has less money in it, literally. So the debts can't be paid off, especially with interest on top of it. Because it takes more money to pay off debt with interest. And the fact that the banks do fractional reserve, right? They, at a compounding rate, increase the money supply. All right. So the milkshake theory, right? You have all these countries and their corporations, not the U.S., globally. The U.S. is special, right? Because it has the world reserve currency status, right? So that's why the dollar is... If you looked at my thumbnail, it's a milkshake, right? And there's a straw that comes out on top of it, and I put the dollar at the top of the straw. That's because the dollar, supposedly, according to this theory, will strengthen because all the liquidity and the demand for the dollar, because of the rest of the world's debt in dollar terms and the interest on top of it, will create this sucking vacuum where endless capital from the rest of the world will go into U.S. markets and will go into the dollar. Well, it won't go into the dollar. There'll just be endless demand for dollars because all the debt around the world is denominated in dollars, or not all of it, but most of it. All right. Now everyone's thinking, well, why doesn't the rest of the world just default then in dollars? Well, why did they take on their debt in dollars in the first place? That's because the dollar is king, right? It's the world reserve currency status. It's very liquid. It's the most liquid currency. in the world. It's the easiest to transact with, this and that, and it's been the most stable. All right. So what if the rest of the world defaults in dollars? Well, then the demand for dollars goes up. Because if everyone defaults, then the supply of dollars shrinks in the world. And not just that, I guess if he was saying that if you default, right, then no one's going to lend you money ever again. I guess that's a good unless everyone's defaulting all at once. At that point, everyone's like, screw it, I don't care. But I think so what he's saying, it's actually been happening for like the past year. So he's been right, sort of. And we've seen actually a lot of strength in the dollar. Proof of that is all these colored lines, these are other fiat currencies versus gold. So that's why gold's so important. It's the only thing that actually isn't manipulated by all this. Well, it's also manipulated. It's undervalued. But gold shows the real strength of a nation and its currency, right? So here's all the other fiat currencies around the world versus gold. They hit all of them. All of them hit all-time high in August of 2019. All of them. Like the major ones that matter. But what about the dollar? Here's the dollar. So this purple line, that's where the all-time high was for all of them versus gold. So what I'm trying to say is gold has hit all-time highs versus other currencies around the world except the dollar. But you could see, if I zoom out, in dollar terms, it did not. We hit 1560 in August. Close to the all-time highs, but not quite there. All right. So the thicker green line is the dollar. Here, let me show you guys. I'll take away all of the other currencies. Just give me a second. There's a lot of currencies. Okay. Here we go. So here's the dollar. See? Now in 2017, it didn't. That purple line is. Here we go. So where's 2012? All right. So it looks different. The all-time high in the dollar. So the dollar is stronger than the other currencies because it doesn't hit the purple line up here, right? But you have to look at it differently. This is dollar versus gold. So the dollar, wait a minute, where's gold? Here's gold. There we go. So gold hit all-time high here back in 2011. And this is where the price hit recently, right? So this green line is just, it's confusing. Like I said, guys, this isn't going to be easy to explain. But once you get it, the light bulb hits. All right. So we did not hit, in the dollar terms, we didn't hit all-time high in gold. Okay. All right. So let's get back to the milkshake theory. Now, I believe in the short term, and currently, he is right. The milkshake theory guy. In the long term, I do not think the dollar is going to stay the strong. Well, the dollar is going to fall in value. Versus other fiat currencies, I don't know. Well, it depends which countries have the most debt and whatnot. But all fiat currencies are going to lose value against real world things. The real world. All right? Services, products, energy, all that. But the problem with the milkshake theory is if the dollar actually rises in value, not nominally against other fiat currencies, but actually in value, then the federal government, right? So for the U.S., wouldn't be able to pay off its own debt and the unfunded liabilities and everything else, like Social Security, all of that, which is U.S. unfunded liabilities is at 127 trillion. The U.S. economy is only at 21 trillion. All right, huge. And then the national debt is at 23 trillion. So the dollar can't actually strengthen in real terms. Now, versus other fiat currencies, absolutely it can strengthen. Now, I do believe when things start falling apart, right, the dollar is going to do the exact same thing as it did in 2008 during that financial crisis, which is it's going to go up. It's going to go up in value for the short term. So right in the beginning, we're going to get deflation. But I don't know how long it'll last. Hopefully it'll last a year or something. But the problem is, so before I get into that, here's the US dollar, right? Monthly chart. Here's 2008, the financial crisis, right? As you can see right here, the dollar shot up instantly within like 6 months. That was a flight to safety. And then soon after, it started losing its value. But this is, again, the DXY, which is versus other fiat currencies. In the real world, at first we experienced deflation, I remember. And then we started getting more inflation. And if you guys don't think there's inflation, come on. I'm in my 30s. I remember when I was a kid, I just went grocery shopping last night. I spent $180. And that's about enough food for about 2 weeks. Maybe 2.5. For just me, one person. $180 when I was a child would buy an entire family of 4 food for a month, if not more. Now, wages haven't increased, haven't kept up with inflation. And, of course, we all know that they skew the numbers, how they measure inflation, all that. We'll talk about that in a second. All right. Now, you can see the dollar here. It was very strong in the 90s. Very strong. And then we had the NASDAQ bubble pop. And then it started falling because Alan Greenspan started this party. This QE money printing and artificially low interest rate party. Right? Now, here is... So what does that take? Where am I on the story of the milkshake theory and the strong dollar? So this is the argument of inflation versus deflation, and I know Harry Dent's argument that he's already lost his bets and he's wrong. He just has a great marketing campaign. He's right about demographics though, the baby boomers, this and that, and he thinks right? He thinks that when SHTF happens, that the dollar supply will shrink. Okay? And that is because when people default on all their loans, that decreases the supply of money, and money disappears. And the central banks, no matter what, they'll just keep printing and printing, but it won't be enough, and the US will end up like Japan, where you just get kind of like this non-growing economy with high inflation, but nothing too crazy out of control. Like the plebs, right? The masses will put up with it because, they're dumb. But it's not noticeable enough for the plebs to start, and going in the streets currently in France and other places in the world, right? But I don't think that's what's going to happen. In the beginning, that could happen. So my theory is, in the beginning stages, right, the dollar will strengthen if the stock market falls. Again, here's another reason why I think they're going to just print so much money. Because, let me show you this. Here's the S&P 500. All right. This is 1971 all the way back here. See that? At the beginning of the chart when we came off the gold standard. And then straight up. Now, if you guys have noticed in the past 3 years, you've actually heard Trump say, I want a strong dollar, and then he would backpedal and say, no, I want a weak dollar. And that's just him trying to manage the currency markets and manipulate them. But what they want to do is have like this crazy balancing act of where they don't want a strong dollar, but they don't want a super weak dollar either, right? Because if it gets too weak, then people will lose confidence in it, and that's when you get the hyperinflation, right? But and we're nowhere near that yet. Another thing is the federal government loves the stock market going up. Why is that? Because they get a lot of tax revenue from it. That's where a lot of tax money comes from. It's from taxing corporations and capital gains. And it's much easier to tax those than to tax the public, the masses. And most of the public don't even own stock. It's like, I think it's, I'm not exactly sure, but it's like 30%. At the most, it's 40 own stock. And it's mainly baby boomer. It's just people's retirement funds, right? And they need the stock market going up. And they can't, and the federal government can't actually survive if it crashes more than like 40%, because then the tax revenues just disappear. And what are they going to do? Tax the public who just lost their jobs? Right? So if the stock market falls, people lose their jobs because a bunch of corporations and companies are going to go out of business. And eventually, because the real economy has been so financialized at this point, it's 30% GDP. What happens is stock market falls, so does the real economy, and people lose their jobs, right? And then who are you going to tax? So, and not just that, if the stock market falls, everyone's going to claim losses, not gains. So then the revenue is gone. So where is the Fed going to get the revenue to keep spending? And then where's the money going to come from to pay out the welfare that people are going to need once they lose their jobs? See how everything's intertwined? And it's such a... It's like a web of fiat, credit, phantom money. It's just smoke and mirrors. Guys, I'm telling you, everything is just... It's such a Ponzi scheme. Yeah, so they can't handle the stock market actually crashing. So what are they going to do? What they need to do is to increase the velocity of money, which is the M2. Well, this is the M2 money supply, right? And this is the velocity of M2 money supply. They took away M3. I will talk about M3 money supply, which is more important. And I don't want to get into economics, guys. Go look up what M1 through I think 6, that's the most supply is. But the M2 money supply is literally the supply of cash or money out there, right? But the velocity of it. So what's velocity? Velocity is the money in the system being transacted, like exchanged. So when I hand you $1 and then you go, spend it, and then someone takes that dollar and then saves it and then spends it here, whatever. It's the velocity of money. So in a healthy economy, money is being well, in a healthy economy, you have high savings. And we're going to look at the savings rate as well. And I promise all of this is going to come together, hopefully. But the velocity of money is the problem. It's been dropping ever since the NASDAQ bubble popped, or the late 90s. And why is that? It's because the economy is weak. And money isn't flowing. That's what velocity is. It's not flowing through the economy. Where's all the money going? Because guess what? Public savings, here's the personal savings rate. It's ticked up a little bit in the past since the recession in 2008, 9, and 10, right? It's picked up a little bit, but nothing really that crazy. So where's all the money going? If it's not going into people's savings, well, it's going into the stock market. And it's going into maybe bonds as well. So government debt, right? Bonds. That's where all the money is. And in some assets, right? But, when you buy assets, it usually ends up at a corporation or a bank. And then usually from there, it heads into the stock market and the treasury markets, right? So the velocity of money is low because the plebs, the masses, the sheep, don't have money, right? And they don't have savings either, and they're not transacting as much as they used to. Like, it's pretty insane that the velocity of money has fallen so much since the 90s. Because technically there's what? Probably 40 more million people since the 90s, population-wise. And then the economy, technically, according to GDP numbers, whatever, has grown so much. But how has then the flow of money been shrinking in the economy? Right? Something's off. And this chart goes all the way back to 1960s. So in what I'm trying to show you, this is the ratio as well, compared to other things. All right. So here's household debt to GDP. So since now I can't go any further back. It's weird that they won't let me, probably because they don't want you to see that household debt used to be much, much lower. Because look, this number on the y-axis over here is it starts at 75, right? It doesn't start at 0. So they won't let you look back further. Either way, household debt, I guarantee you, it's up there. Now, household debt prior to 2008 was higher than the current household debt. But that's also because people just had more money back then, and we had the housing, a lot of people's debt was wrapped up in homes, and there were house flippers and whatnot, right? So I just want to, show you that. Here's United States private debt to GDP. Now, here's a better chart since 1995. This is from this is from Trading Economics. It's still pretty high, all right? And right before, so back in 2007 and 8, it was higher. And it was at, just from looking at this from the y-axis ratio, it was at 212 at the all-time high. It's when the economy peaked out, and then we had the Great Recession, right? The mortgage-backed security crisis. But prior to that, look at private debt. It was all the way down to 156 in 1995. I don't know about you guys, but I remember the 90s. The 90s were booming compared to today. The economy. I mean, I remember. I was old enough to remember. I was, I was past 10 years old. I remember. It was good times, the 90s. It was best times compared to economy-wise, right? Things were just, people were out and about. Everyone had good jobs. Things were great. We had pop music. But you guys know what I mean. We're old enough. And yeah, so private debt, it's much greater. It's at least 20 to 30% greater currently than it was in the 90s. But not quite where it was before Great Recession. So what else? Now, the inflation side of the argument, why the US dollar is going to become really, really weak in the end, is because other nations are looking to de-dollarize. And literally, Putin said that the dollar will collapse soon. And he said this not too long ago, a few months ago. November 15, 2000. Oh, wasn't that long ago. November 15, 2019. And other countries really are moving. They're trying to move away. The BRICS nations, countries are looking to conduct even more trade in their own currencies instead of dollars. And China is actively trying to get other nations to use their currency. They're actually in the foreign currency swap markets. And they're trying to get... Where's that article? Here we go. The most important function of the currency swap agreement is to promote the use of the yuan in trade and increase its market liquidity. And this article was actually, I think, an Asian article. I mean, they're pretty honest of what they're doing. In recent years, China has signed currency swap agreements with South Korea, Malaysia, Argentina, Iceland, and other countries with expanding scale. This is one of the important measures to promote the internationalization of the yuan, and also it reflects the common vision of these countries committed to de-dollarization. Turkey's also doing it because of sanctions, Iran, right? And even European nations are trading with other currencies, trading through other currencies for energy like oil and gas. And eventually a lot of energy comes from Russia and from the Middle East. And China's demand is huge for it. But China, Russia, and then some of the Middle Eastern countries now are trying to get the world to move away, to trade with them and their currencies. So that's that's the end game. So the milkshake theory, like I said, it's not wrong. I think for the short term, and what is short term? I don't know. It could be 3 months to 3 years. I'm not certain. I just know the order of things. That's why I'm paying attention and looking at the charts and everything, right? So I think in the long term, though, the problem's going to have the dollar is going to have serious issues because of literally foreign nations not wanting. They know that they also believe that there's possibly more dollars even in circulation than people think. There's actually more dollars outside of the U.S. than within. And then those dollars, and that's because of all the debt, right? The other nations have taken, but there's also a lot of savings in dollars with foreign entities, corporations, people, and countries. And if there's ever a crack in the dollar, meaning people actually think that it's going to keep losing value in a big way, then those dollars are all going to come back to the U.S. all at once. And that's when you see a huge hit to the dollar. And this sort of happened with the sterling, right? With the United Kingdom, because that was pretty much the final nail in that empire. Besides, but and remember Soros was known for shorting or was it the pound back then, or was it called the sterling? Same thing, whatever. The UK's currency, right? Anyways, let me get back to what I was saying. You could go off on so many different directions with this because it's so intertwined, because fiat currencies are intertwined with everything. Anyways, another reason is is the entitlements, right, in the U.S. and the fact that the banks were bailed out last time during the last financial crisis. This time around, we just had one of the central bankers, Kashikari, what's his name? They're literally calling for MMT. So MMT, right, is a bailout for the average citizen, for the average person, American. That's extremely inflationary. Very, very inflationary. Because that is actually going to increase the velocity of money. Because if everyone's getting $1,000 a month or whatever they're going to do, helicopter money, that's when the inflation genie is going to come out of the bottle. I mean, it's technically already come out of the bottle because we're going above 2% inflation. And 2% inflation year over year compounded is like 20 years from now. I don't know. A loaf of bread's still going to be like $20 or $50. But of course, inflation's higher than that. And I'll show you guys some stats in a minute. But let's take a look at these charts. So here's the S&P 500. Here's the M2 money supply. So look at this. The supply of actual fiat looks very similar to the stock market. Gee, I wonder why. What did I tell you? Where was all that money going? Here's M2 velocity. So the velocity of the money supply. So the money being turned and exchanged in the movement of money. For a healthy economy, you need higher velocity of money exchanging. Because that means that business is happening, right? So if you went to a market, any market, say a flea market or something, if nobody's handing each other money, then no one's shopping and buying or selling. Get it? What's this? Here's the CPI according to the Fed's statistics, whatever. So even according to their inflation measurements, the CPI, inflation's been going up. But it's worse than that. This is... What is this? So this is the savings of the public, right? So let me remove some of the other ones I just showed you. I'll leave M2 money supply. That's green. The purple is the savings of people, right? And that's been falling steadily since they've been printing money, literally since 1971, right? So people's savings. Yes, there's a little bit of an uptick, but again, it doesn't matter in dollar terms if your savings are going up, because $10,000. So let's say $10,000 of today's savings is nothing compared to $10,000 of someone in the 1970s. In the 1970s, $10,000 would buy you like a really nice car. What would $10,000 buy you in the 70s? A lot of things. Homes used to only be like $50,000 back then. Like really nice homes. Those homes still exist, right? Currently, but today they're priced around $250,000 or $170,000, something like that. So a $50,000 home from the 70s now costs like $170,000, right? So $10,000 went a really long way back then compared to today's savings, because that doesn't count for the inflation. This is just the purple. It just counts for in dollar terms you're saving. All right. And then here's your that doesn't matter. All right. Where to from here? You guys should look at this. nationaldebtclock.org. There's a lot of fun stuff on here. Here's another article. Well, what did I want to talk about on here? I did. So U.S. debt held by foreign countries is actually almost $7 trillion. So the gross domestic product, the economy is worth 21 trillion a year, every year, right? But the foreign debt is 7 trillion. That's a lot. That's almost 1/3 of our entire economy, the US's economy. So the milkshake theory, like I said, guys, I think he's right, which is awesome. Awesome for us in the private group, right? Who if we're investing in metal stocks, when those go up in value, there's a high likelihood possibility that we're in a deflationary environment, and then you could actually buy up assets cheaper than today's prices. But you're going to be making money on the upside of the crisis, because it doesn't matter what the crisis is. If there's a crisis, gold goes up. So if it's a deflationary crisis, the Great Depression, gold went up in value. Except, who was it? Was it Truman? Roosevelt. No, it was Roosevelt was the president, right? And he confiscated the metals. They're not going to be able to do that this time, though. But, yeah, so he confiscated it because the value was going up, right? And the nation needed it because they were having the Great Depression, because of the 1930s Great Depression, right? So we could probably experience globally a Great Depression, and then the central banks are going to panic. They're going to get the velocity of money up. They're going to do MMT, helicopter money, because if they don't, then guess what happens? The federal governments all around the world actually go bankrupt. Like, they default on everything, which is what? The unfunded liabilities. And what happens if you default on that? You get riots. Like, you get uprisings, right? And they don't want that. So they're just going to print. And they like that because it actually lowers the amount of debt they owe to their own public and everyone else, even foreign nations and whatnot. Of course, their bond market will blow up, which means then the stock markets and the equity markets blow up. So maybe a blow off top, melt up for the short term, for the next year, 6 months, 3 months. But then eventually it's going to blow up. Everything will. I don't know. I don't think the world's ever seen anything quite like this. I mean, it really hasn't. The amount of debt and but I guarantee you, to stop, the plebs from grabbing their pitchforks, they're gonna do MMT and helicopter money. And in the beginning, it's gonna stop the depression and kind of stabilize things, and we might get like a Japanification, stagflationary environment. But then all of a sudden, inflation's gonna just explode out of nowhere, and then finally the system fully melts down. Maybe. Listen, guys, I'm just theorizing right now. This is a complicated topic. It's hard to explain and understand. Shadowstats.com, right? No, this is a wage growth tracker. Here's another website. I'm bouncing around now because I didn't see this tab. I have like 50 tabs open. Yeah, I mean, wage growth has been falling. I already showed you guys that. But here's Shadow Stats and website, and he calculates inflation, jobs numbers, all the data that the Fed, that the central bankers calculate, right? But they changed it, and he's been calculating it how they used to, like back in the 80s or 70s or 1990, before 1990. And yeah, the CPI much higher, consumer inflation much higher than they report. The red is them, the blue is the older way they used to calculate it. And I just want to show you guys that as well. So I'm going to leave you with this. What am I going to leave you with? Goldman Sachs says central banks gobbled up 20% of global gold supply. 20% of the entire global supply. What does that tell you? It's safe to say they're preparing. They know they're not stupid, and it's safe to say that the prices are probably gonna go up a lot, and there will be some sort of reset towards hard money, right? So links in the description below this video. 15% off in the private group. I share my trades. You guys learn how to trade. Free trading academy. I share the indicators I use, the ones that I found that work for me. We're doing research on mining stocks. It's just a community. We share information. Everyone's sort of helping me out as well. They find great picks. And then we research it. We look at the balance sheet, this and that, and you'll get a report, and then it's $10 a month, and you cancel that at any time. So I'm excited. It's good. We're gonna live through some real interesting times. The milkshake theory, like I said, I'm gonna end it on this. It's been the milkshake theory. Yes, it's happening right now. I think it's going to end pretty soon, probably by the end of 2020, though. And then we're going to go into the second phase of everything. And then we could actually see a deflationary period. Don't know how long that's going to last. And then eventually, and politically, in the next, at the end of the next 4 years, depends. Trump's probably going to win, so after him, but he's very inflationary as well, right? He keeps calling for negative interest rates or near zero interest rates. So it doesn't matter. I mean, they have to keep the interest rates low forever and keep printing to keep things from imploding. But once things start really imploding globally, all central banks all around the world are going to just flood the world with fiat. Because they're scared to death if they don't. Because if they don't, then you get a 1930s style depression, but worse. So they would rather keep the music going as long as humanly possible so they don't have to live through it themselves and they get reelected. And yeah, pretty much. That's pretty much my thoughts, guys. So all the people in charge, they're going to keep the music going as long as they possibly can, and they'll print. It doesn't matter. They'll just keep printing, because the other alternative is to let the free market reset all of the shenanigans and the endless, money printing. And if they do that, it's going to be really, really painful. So I think everyone in charge, right, the control structure, what they're going to do is they're going to shoot for Japan-style economy. They'll buy stocks if they have to. They'll do whatever they can. I just don't think it's going to work. I mean, it might work for some time, but there's a reason why their central banks are buying gold, right? It's because if everything really does implode, they could, at least they will have metals, and then they could start a whole new financial system globally, right? If you enjoyed this video, smash some likes, leave anything in the comment section. Hopefully this wasn't too long. Hopefully you learned something. And check out all the links below my video. Use them. And I'll see you guys in the chat groups, the free ones, the newsroom. I'll post that video in the newsroom again. Alright guys, until next time.